In my career, almost 36 years, I've never seen Wall Street or Main Street acquiesce to anything other than 5% of gold, of an asset, a portfolio rather, being in gold. And, and it was acquiescing at best. Fine, put 5% of your money in gold. Now, recently we've seen the chief investment officer of Morgan Stanley say, no, sell half your bonds and buy gold. Their new platform, according to him, is 60 stock, 20 bond, 20 gold. You got Michael Hartnett, the chief analyst for Bank of America, with this very, very, very expensive newsletter that goes directly to the institutional trader. It's like many thousands of dollars a year. I think we're at a tipping point in the silver market. And I mean, I think you point to the growing shortage of physical supply at the highest levels, the LBMA, the COMEX, and now even the Shanghai market. They're all showing stress, if you will, in supply, and the amount of, or the number of deliveries is off the chart. And coupled with, surging demand for things like industrial, investment, central banks, sovereign wealth, the same stuff we've been talking about forever, man. Silver is being pulled from every direction. That's just the bottom line. And not enough talk about it anywhere except on the alternative media channels, so it doesn't gain any traction. But where you will start to see some traction, in my mind, is the fact that the U.S. government just designated it as a critical mineral. And to me, this changes the narrative. Silver is no longer just a commodity. It's a matter of national security, national strategy. And when you talk about the kind of potential that silver has, remember that in terms of market cap, it's the tiniest little nothing market. And when capital begins to flow in, like the United States government and the sovereign wealth funds, it doesn't move gradually, it will erupt at some point. I do believe that. But the bottom line, Jesse, is you got tight supply, you got surging demand at the highest levels, coupled with systemic risk and the LBMA and what could happen if we see a delivery failure, coupled with official recognition. I would say silver isn't just poised to move, it's ready to explode. And yeah, it has been catching its breath, and anything that moved that fast, 40% in a couple of months, is overbought. That's the definition of overbought, and it needed to correct. It did, and here we are back above 50 again. So yeah, I say buckle up for what's coming next.
A major shift has begun. The United States now classifies silver as a critical mineral, a designation typically reserved for resources essential to national defense and technology sovereignty. This move transforms silver from a simple industrial input to a strategic asset. Other nations are responding. China is actively restricting silver exports to secure its own needs. When governments recognize a metal as essential to national policy, capital doesn't trickle in. It erupts in large, sudden waves. Silver's tiny market size means that when official money moves, prices can explode with very little warning.
I'm not trying to be anything other than honest. Either many of the things I say, people could say I'm stupid for saying them, or maybe I just have the courage to say what I believe. And I have been saying this on your show for a long time. This is confirmation of what I've been saying. The fact that the U.S. just named silver a critical mineral, along with China's tightening exports, there's no coincidence there. This is governments recognizing, I think, silver's strategic importance. Go back a year or two, Canada, many of the miners and players in the silver market in Canada tried to do the same thing, to have it reclassified a strategic metal, not an industrial metal. But this is an understanding, an awakening. It means a floor has been put under demand, number one. You have policy-driven buying now that will be coming in from the U.S. and from other countries like China, who will see that this is musical chairs, if you will. And at the same time, you have a global supply crunch. You got players getting squeezed, and you get China, who is, a big player in the silver market, limiting exports. That's a big deal. Now, silver isn't just an industrial metal anymore, Jesse. It's obviously strategic, and it's monetary. It's essential. And I think now that governments are making that official, I think from the highest levels, maybe governments just lit the fuse. So yeah, I I think it's a big deal. It's a huge deal, bigger than just about anything I've seen in a long time in the silver market.
Evidence of a geopolitical accumulation campaign is growing. India has purchased up to 800 million ounces of silver in recent years. Russia has declared silver part of its strategic reserve. China, already the world's second largest producer, is bypassing traditional markets and flying directly to South American miners, paying premiums for doré bars and concentrates, then refining the metal at home. BRICS nations appear to be building commodity-backed influence to counter Western financial power. In a world where supply chains are increasingly weaponized, he who controls the metals controls the future.
We know that India has been a massive player in the silver market. You can find quotes that it's purchased between 6, 7, 800 million ounces in the last 5 or 6 years. Copious amounts. We know that Russia said we're going to add it to our strategic stockpile, being one of the first countries ever to say that. We see massive deliveries. Talk to David Jensen on the COMEX, the LBMA numbers. Huge deliveries coming off the LBMA in a hugely rehypothecated market where way more contracts exist than bars standing behind it. To your point, we saw Saudi Arabia jump in, and I think it bummed a lot of people out that they bought SLV, but the amount that they bought in SLV allows them to actually stand for delivery. I think there are a lot more countries that have been doing this just on the down low than we are led to believe. You look at China as the second largest producer in the world, flying all around South America, going directly to the miners. Sean Kunkun has talked about this, CEO Dolly Varden, where they go right to the miners, disintermediating the marketplace, buying doré and concentrate right from the miners, paying double what the West will, and sending it back to China to refine it. They control the majority of all the metal refining and rare earth refining, so they just put it on a barge and send it on back to China. But it's coming from the second largest producer in the world, so that should put a little bit of context into it. If they're making that much or producing that much, why fly all the way to South America to pay double what the West will to buy doré and concentrate and send it back for refining? I think you will see that. I think it's been there under the surface if you really dig. But I think a lot of countries, especially those in the BRICS, have understood that, silver is and gold. This is a race for the world's commodities. And it's not just the precious metals. It's the base metals. It's the soft commodities. He or she who has the gold makes the rules is how it used to be. How about he or she who has all the world's commodities makes the rules in the coming future? And I think that's what you're seeing. So, yes, I do think you'll see more countries and sovereign wealth funds probably at some point. It'll be more transparent what they're doing. But in a world where information travels so quickly, it doesn't behoove any of these players to let anyone know just how much silver they're gathering. And then look at the U.S. I don't care what anyone says. It ain't about tariffs. I've been saying that for a year now. It is not about tariffs. It is not about arbitrage. Sure, there's a little bit of that truth, but it's being reshored. And, I've been screaming this. Look, all this silver coming into the country can't just be about tariffs. That was the ruse to get it all back here. Some of it's flowed back to ease the burden at the LBMA. But what it really is the smart money trading ahead of the news. Like, they knew that this was going to happen. They knew that it was going to be reclassified a critical mineral. So what do? They reshore it. They say it's tariffs so that London releases it and Switzerland sends it. Oh, by the way, it's reclassified. Everything that at that level that they do, you look at all the massive gold accumulation in 2016, 17, 18, and 19, and then the Basel III reclassification of gold. These things that at the highest level, information is worth more than anything. And the people accumulating it, the central banks, the sovereign wealth funds, they're not just the most well-funded. More importantly, Jess, they're the most well-informed. And I think that's really what you would expect to see, the inside money moving first. And I think we're transitioning to that point where it's now out in the open, at least more so than it's ever been. And at that point, it's anonymity be damned. It's everyone rushed to secure what they can while they can. So yeah, I think you will see that.
Silver is one of the most leveraged markets on Earth. On paper, futures contracts represent vastly more metal than physically exists in vaults. Large deliveries are draining supplies from the LBMA and COMEX simultaneously. an unprecedented situation. If a major buyer demands delivery the system cannot fulfill, it could trigger a global default cascade. Sovereign funds, including Saudi Arabia's, are now positioned to stand for delivery instead of cash settlement. This game of musical chairs has fewer chairs every month. The moment confidence breaks, the scramble for real ounces begins.
Let's just state something that I've never seen before in my career, and I've talked a little bit about this, but it's worth mentioning to your listeners. Look, in my career, almost 36 years, I've never seen Wall Street or Main Street acquiesce to anything other than 5% of gold, of an asset, a portfolio rather, being in gold. And, and it was acquiescing at best. Fine, put 5% of your money in gold. Now, recently we've seen the chief investment officer of Morgan Stanley say, no, sell half your bonds and buy gold. Their new platform, according to him, is 60 stock, 20 bond, 20 gold. You got Michael Hartnett, the chief analyst for Bank of America, with this very, very, very expensive newsletter that goes directly to the institutional trader. It's like many thousands of dollars a year. He's saying, no, it's 25, 25, 25, 25, 25 gold, stock, bond, short-term treasuries, gold. You got Jeffrey Gundlach, the bond king, saying, no, 66, what did he say? Jeffrey Gundlach said, 25% in gold, Monday morning. 25% in gold is not overweight. And then the 6,600 part, that's Jeffries. They used to be a primary distributor for all the world's mints. And they said 6,600 is their next target, at least intermediary target, for where they expect gold to go before it takes a little bit of a breather. You have massive institutional money, traders and analysts and chief investment officers speaking to the most sophisticated traders in North America, saying 25% of your portfolio in gold is not too much. I mean, that's just insanity, if you ask me. Goldman Sachs said, if 5% of the money comes out of the bond market because they fear that there is no independence on the Fed anymore, that gold would go to 5,000 like that. Well, when you have Stephen Mirren sitting in the Fed, who it was Trump's advisor and the architect of the Mar-a-Lago Accord, he fills the vacated spot. What independence? The Fed has no independence. So gold is moving in that direction. You got Bank of America just saying $67 for silver is their target for next year. So when we talk about record highs around 4,400 gold and then it falling off and everyone's saying it's over, I find it disingenuous at best when you have these analysts saying this. And here we are back up above $4,100, and that shows the strength and the underlying support. So gold's held up because of central bank accumulation. And to me, that's what we've been saying forever. We've seen physical demand rising and global monetary stress increasing, all of the stuff that we talk about. But what I believe we are seeing, kind of what we were just talking about, is a slow motion global run on physical gold. And the pullback from those highs wasn't a breakdown, it was a consolidation. Catching its breath, not throwing in the towel. Pick your euphemism. But the bottom line is gold isn't just strong, it's structurally more attractive than many people realize. And I think that the recent pause is the calm before the next leg higher. That I do believe. And maybe this is it here today as we're up over $100 as we're talking.
For decades, banks told investors to allocate just 5% to precious metals. Reluctantly, that era is over. Top strategists from Morgan Stanley, Bank of America, Jeffries, and legendary investor Jeff Gundlach now recommend 20-25% in gold, citing loss of confidence in government debt and central bank policy. Silver benefits even more. Bank of America projects $67 per ounce in the near term. Institutions are signaling a shift away from financial assets that depend on trust and toward assets that need no permission to hold value. This is a historic reversal in portfolio strategy.
Yeah, I look at it a different way, Jesse. I mean, I think what they're trying to do, if I'm going to guess, is to reshore manufacturing. And the only way you do that is to massively devalue the dollar. Look at Triffin's dilemma, which says as the world reserve currency, you will always have a net deficit in global trade because your major export's going to be dollars. The world needs more dollars than we can provide through trade alone. And so countries over time have to sell their currency to buy ours, weakening theirs, strengthening ours against those currencies, that is. And so over time, manufacturing flows to where it can be produced the cheapest. Vice President Vance has come out on White House letterhead saying, no, we can't do this anymore. Triffin's dilemma, it has been a subsidy for the consumer. It's been a massive hindrance for the producer. It's a broken system. We have to move away from it. Even the knucklehead that was Jared Bernstein, a true knucklehead, if anyone remembers him trying to explain how treasuries were created, he was the White House lead economic advisor under the previous administration. He did write a report called Dethrone King Dollar, where he says the same thing. Being the reserve currency is now a hindrance rather than a benefit. Now, if you are trying to bring back manufacturing, you have to have a weaker dollar. How do you get a weaker dollar? You let gold go to levels that no one can imagine, and I think you will see that. Now, you could argue Bitcoin too, but take a look at USA Tether as an example. USA Tether, which is already Genius Act compliant, their CEO is a man named Bo Hines. Bo Hines was Trump's crypto czar until August. So the rules that Bo Hines was creating, he is now benefiting from. What is Tether doing? They have 12 billion in gold right now, more than they have in Bitcoin. About 8 billion they have in Bitcoin, according to their last numbers that just came out. They were just at the Beaver Creek Mining Summit as a company, Tether was, which is one of the biggest mining summits in the country. Again, talk about Chinese disintermediating the market. Now, Tether is. So let's just play this out. The Genius Act says that any time, and to your point, I think they are using the cryptosphere, if you will, to get to where they want to go. And I know that sounds kind of crazy. I mean, it's like, here's how it works. So anytime money moves, it'll be backed by a stablecoin. It will move instantly, like Venmo or Zelle across a blockchain network, instant settlement, if you will, and it will be backed by U.S. treasuries. Now, the interest on those treasuries is not transferable to the holder of the stablecoin. In other words, Tether gets to keep that interest. What are they doing with it? Well, they're buying more gold than they are Bitcoin, but they're buying Bitcoin too. Now, if you realize that Bo Hines is in this and kind of an advisor, what if they've worked out a deal with some of these stablecoin holders? Say, here's what you're going to do. Anytime a dollar moves across the globe, you're going to back it with U.S. treasuries to lower the rates synthetically, not organically. You're going to do that. And then you're going to take the proceeds and you're going to buy Bitcoin to someday maybe pay down the debt. And you're going to buy gold, not to let gold go much higher just for the hell of it, but because rising gold devalues the dollar, right? And makes exports more attractive. Now, you mentioned backing U.S. treasuries. I mean, we had Michelle McCory, who runs part of my YouTube channel, had Judy Shelton on again. I had her on 6 months ago, but she said the same thing to Michelle, that in no uncertain terms, she believes, according to what Trump told her, that we will peg the back end of the bond market to gold July 4th of next year, the 250th anniversary of the country. So let's put it all together. So if you have synthetic demand created through the stablecoin movements, by everything has to be backed by short-term U.S. treasuries, and then that pushes rates down, gives demand to the treasury synthetically to run the government, and the proceeds of those things go to gold, which raises it synthetically, and to Bitcoin. At the same time, you now peg it to the back end of the bond market, the 5, 10, 20, 30, and even 50-year treasury. What does that do? Number one, it keeps rates low to stimulate the economy synthetically and gives synthetic demand for the U.S. Treasury. It takes all of that extra money and puts it towards gold and Bitcoin, devaluing the dollar, giving us the ability to slowly pay down our debt using Bitcoin. But now if you take gold and back it to the Treasury market on the back end, you have zero upfront borrowing costs. You bring back your manufacturing at zero upfront borrowing costs. Yes, you have to pay it in gold in 20 or 30 years. Okay, fine. But the upfront borrowing costs are pretty much mitigated to zero, bringing back your manufacturing, reshoring it, making all the new facilities that you need to make at zero upfront borrowing and selling your goods into a massively devalued dollar. In other words, what I believe they are doing, look at all the crumbs, they're giving up on the reserve status in order to support the bond market. And by doing so, they would actually have a fighting chance, perhaps, to grow our way out of a problem. So I do believe that you will see. Now, people talk about, will gold be revalued? Look, that's not conspiracy anymore. It is actually in the Genius Act and says in 2026, they will revalue gold. Now, they could market to market, or maybe they go much higher. James Rickards is saying 24,000. He gets there by dividing the money supply into gold. Not sure exactly how he gets that calculation. It was a while ago when I listened to what he was saying, but the point of it is, you put gold at that level, it benefits every central bank on the planet, but it massively devalues the dollar. That's the point. The dollar in relation to gold would fall tremendously, and that alone would give us the ability to start selling our product to the rest of the world at a devalued dollar, giving up on the reserve status in order to reshore manufacturing, in order to have the ability to grow our way out. We are at a point in time, Jesse, where 60% of this country has a literacy rate below a sixth grade level. 60% can't read past the sixth grade level and have no college education. AI is already kneecapping entry-level jobs, and they predict in 3 or 4 years, half of those entry-level jobs will be affected by AI. So if you don't make anything, and AI is changing the dynamics of the world, and your population is less educated than ever, yeah, you got some problems. So I do think if there is any nobility in what he is trying to do, if I'm right, it is to bring back manufacturing. And the only way to do that would be to revalue gold, to devalue the dollar, give up on the reserve status, as Triffin's dilemma cites. And besides, all these countries around the world, they want to trade in their own currencies. They want to determine their own fate. They want the strength or weakness of their currency to mean something, settling imbalances in gold. And I think we're coming around full circle to gold always being the center of the monetary system. In the BRICS nations, it will be a vehicle to settle trade and currency imbalances. Here, I think it's going to back the treasury market. To retain demand for the treasury market at the same time, they are loosening their desire or relinquishing their desire to maintain world reserve status. So we'll see. That's my thesis, and I've been saying it for a long time, and I believe it. We'll see how it plays out, because if we don't, our next generation and the one after that is in massive trouble, because, you don't live in the AI sphere or on Wall Street. Where are you going to make the money? And I think that's something people need to think about for a moment. And I do think he's trying to bring back manufacturing. This would be the only way to do it.
A worldwide evolution in money is accelerating. The U.S. appears to be quietly preparing a system where gold supports treasury markets again, potentially announced as soon as 2026 under new legislation. Stablecoins backed by U.S. debt could provide liquidity, while gold revaluation weakens the dollar, making manufacturing competitive and reshoring industry. BRICS nations are building a settlement framework using gold and commodities instead of the US dollar. In this monetary realignment, silver becomes indispensable, both an industrial supermetal and a monetary instrument. The fuse has already been lit,